everyone, welcome back. You're watching The Money Show on ET Now. Ever since the PMC Bank debacle, all of us have gotten asking each other the question that I have my money in XYZ bank. Is it safe over there? Or should I keep my deposits in so-and-so small finance bank? It's all got us extremely wary about trusting the banking service in general. And all of us, of course, feel significant pity for those individuals that do have their money in PMC Bank, 4 of whom have unfortunately lost their lives. So how can you ensure that your bank is not going to end up like a PMC Bank or several other cooperative banks as well that have had a tough time in the past? We decided to help you out with a DIY on how you can assess if your cooperative bank is safe. So let's bring on board Mukesh Jain. He's a corporate lawyer and the founder of Mukesh Jain Associates and Associates. Mr. Jain, thank you so much for joining us on The Money Show. The PMC Bank debacle is something that certainly has all of us shook, and it's got all of us questioning that, you know, if this is the case, where is the banking industry headed, right? So we decided that let's do this session where we help our viewers understand that how can they themselves as a lay person check if their cooperative bank is safe. So Mr. Jain, how would you recommend then firstly viewers go about choosing the bank that they should bank with? If suppose I'm an individual, I'm a college going person who just wants to open a bank account, what should be the 3 or 4 or 5 key parameters I should ensure my bank adheres to before I decide that, okay, this is the bank I'm going to bank with?
See, overall the banking sector can be divided in 2 parts. One is commercial banking sector and the other is cooperative banking sector. We are primarily concerned with the health of the cooperative banking sector because as far as commercial banking sector is concerned, they are supported by an implicit sovereign guarantee where the government chips in either by mergers or in case of nationalized banks by induction of capital. As regards the cooperative banking sector, let us first go through a little bit of historical background of how cooperative banks came into being and how they got under dual control of the government of the state and the RBI. Originally, our cooperative movement in the financial sector, it started more like credit and thrift societies. For the first time in 1904, were they brought within the statutory guidelines, and it was not until 1966 that RBI started licensing cooperative banks. So until then they were all together in unlicensed sector. In the year 2000, the government started giving the stature of a scheduled bank to large cooperative banks. Until then, they were not scheduled banks, and a scheduled bank means that they can participate in the clearing directly and they can borrow money from RBI against the government securities. Thereafter, still a lot of cooperative banks remain unlicensed. It may be surprising, but it's a fact. Secondly, even for licensed banks in the cooperative sector, even for scheduled banks in the cooperative sector, RBI has limited control and supervisory jurisdiction only in respect of the banking related functions. As far as the management functions are concerned, they are still with the state government, or in case of multi-state cooperative banks, with the central government. And this duality of control is always a problem. Like for instance, RBI has no say in appointment of key managerial persons of a cooperative bank.
You know, Mr. Jain.
And therefore, the
Mr. Jain,
element of nepotism.
Mr. Jain,
Yeah.
because we have a bit of a constriction when it comes to time. Like you mentioned, a scheduled bank does have a decent amount of RBI and government intervention, involvement, etc. That may not so much so be the case for a cooperative bank. So then, doesn't that in itself be like a warning sign of sorts to an individual that, hey, you know what, it's always better to put your money in a scheduled bank and not in a cooperative bank? I mean, isn't then as simple as isn't it a very simple decision to make in that case?
See, ordinarily, one would put money in a scheduled bank, in a commercial bank, rather than a cooperative bank. But a cooperative bank has its own USPs. There could be historical relationship, there could be easy of accessibility, personalized services, and particularly a small depositor would find working with a cooperative bank probably better and easier than working with a nationalized bank or a commercial bank for that matter. Having said that, I'll come back to your question that how do you discern whether a cooperative bank is good enough to work with or whether your money is safe in a cooperative bank. For an ordinary depositor, let me warn you, it's very difficult to find out, but fortunately we are addressing urban sector depositors who have got access to technology and the media. In case of a cooperative bank, there are a few indicators which will tell you about the health of the cooperative bank. Reserve Bank of India every year publishes some key data about cooperative banks. Out of that key data, 3 major indicators could tell you a telltale story. And those indicators are, number 1, what is the level of capital adequacy of the bank? Reserve Bank has prescribed 10.875%, which means for every 100 rupees of risk bearing assets that you have, you must have capital of 10.875 rupees, which acts as a cushion. Then we come to that what are you earning on your assets? If you are earning 1% and above on your total assets, after discharging your interest liability, after discharging your liability of the overheads, it's a good enough margin. Then comes what are your gross non-performing assets, not net, not post provision. What are your gross NPAs? And in NPAs, it is not only the absolute number, but also how they are behaving from year to year. Now, since PMC is the flavor of the season, let us see how PMC's data compare with these parameters. In case of PMC, ostensibly they had adequate capital adequacy, they were at 12.62, but their profit margin on assets was only 0.75, and their gross NPAs in the relevant period, they went up from 1.9% to 3.79%. Now, second and third indicators are a red signal. Now, despite these signs, there is one more caveat to it. These 3 signs will tell us about the solvency of the bank on the assumption that the accounts present a fair and correct picture of the bank. If the accounts are fudged, if the NPAs are underdeclared, now if the NPAs are underdeclared, it means your profit is overstated, and therefore you are showing your capital to be more than what it actually is. You are showing your earning on assets to be more by recognizing income which you ought not to have. As in the case of PMC, we have seen there were 21,000 bogus accounts where loans were given and their impairment was not taken into account. Another important indicator, which is a lesser known
Mr.
indicator,
Jain, you know what?
but a very potent
Mr.
indicator.
Jain, I'll just request you to hold on because we just need to take a very quick break, but we'll continue with this conversation and the points you were making about other indicators. Just a quick break on the Money Show. Come right back. Welcome back. You're watching The Money Show, where we are discussing how to not get trapped in a PMC-like debacle. And you know, Mr. Jain, you were mentioning those financial indicators. There's capital adequacy ratio, return on assets, and also NPAs, which is published by the RBI for all banks, regardless of cooperative or schedule. So firstly, I want to know, is there, as an individual, do I have to calculate the CAR based on the numbers given by the RBI, or does the RBI directly publish these numbers? Because we want our viewers to be able to access this data. And secondly, are there any other indicators? You know, just before we had to go into break, you were mentioning about some other indicators, sir.
RBI publishes this data, you don't have to deduce it. One thing. The other important indicator is that cooperative banks, except scheduled banks, they don't have access to the clearing house. Besides, they don't have such a network as the nationalized banks and other bigger banks have. So they require corresponding arrangements for remittances, for participation in the clearing. Besides, some banks like PMC Bank also have foreign exchange license, but they are not so well established as to be accepted in the international market. Despite having foreign exchange license, no bank in USA will accept a letter of credit issued by say a cooperative bank. So they have to necessarily operate through some commercial bank, generally a nationalized bank. Now that is a very important safety net, because any bank, before they accept a cooperative bank for a correspondent arrangement, do a very detailed due diligence, so much so that the proposal has the approval of the board committee of the nationalized bank, and they review it on a year-to-year basis. Therefore, to know as to who is the correspondent bank of a particular cooperative bank, that can be a very important indicator because the correspondent bank will not agree to own up liabilities to third parties, say to the clearing house or to a bank accepting remittance made through the corresponding bank, or a foreign bank accepting a letter of credit which has been opened at the behest of the cooperative bank. Now, if I have a stable and steady corresponding arrangements with a reputed bank, much better a nationalized bank, on an ongoing basis, and the relationship is stable, that is a very big indicator of the stability of the cooperative bank. There could be some other operational indicators also. For instance, the bank falling short of cash repeatedly. You go and want to withdraw and bole saab 2 ghante baad aana. So those things, or your facilities are sanctioned but are not being disbursed. These are the indicators that the bank is under a liquidity stress, and that liquidity stress could be because of a general financial ill health. Now all these indicators must not be neglected. One should act upon them. Reason being, a cooperative bank has got DICGC cover, but that is only up to 1 lakh rupees per depositor. Today the news is flashing that RBI has upped the limit for PMC Bank up to 50,000 rupees, and they are saying X percentage of depositors will be able to withdraw their entire money. But let us not forget that the state government has mandated that all cooperative societies should bank only with cooperative banks. Now SBI Credit and Thrift Society has their money stuck in PMBC. Both employees and officers societies of RBI are having their account with PMC Bank. Several Gurdwara committees have got their account with PMC banks. Now these major depositors, their funds are stuck. No doubt the government has, the Reserve Bank has alleviated the public distress.
True.
But the problem remains.
True, true. Okay, that was very, very insightful, and I'm sure very actionable intelligence as well shared by you, for all our viewers. Guys, the data is available on the RBI website, and something as simple as if your bank is not able to, some basic operative issues like the bank is running out of cash, etc. That is something that even you guys can assess. Mr. Jain, thank you so much for this comprehensive analysis of how an individual, maybe without much knowledge as well, can check if their cooperative bank is safe. Mr. Jain had also shared some parameters, so make sure ensure you adhere to that. On that note, we'll wrap it up on the Money Show. So thank you so much, folks, for watching.